Good evening and a very warm welcome to all of you from London South East. For those of you who don't know me, I'm Donald Leggett, Head of Investor Relations at London South East, and I'm your host for this evening. Once again, we're delighted to welcome our event sponsors, Primary Bid. Primary Bid's focus is to give retail investors like yourselves equal access to IPOs and one-off public company fundraisings on the same terms as institutional investors. The best way to keep up to date with their flow of IPOs and capital raises is to register at primarybid.com. The four natural resources companies who are speaking tonight are IronRidge Resources, Advance Energy, Emmerson plc, and Technology and Minerals. Each CEO, as per normal, gets 30 minutes to make their investment case, with 18 minutes or so spent talking to slides, and then we take questions from you, the audience. Our first company tonight is AIM-listed IronRidge Resources, which has a market cap of around 110 million currently, and IronRidge has made three major mining discoveries in 3 years, which is a great record, and with the most commercially advanced being the fully funded lithium assets at Ewoyaa in Ghana. Next is the Zarano Gold Project in Cote d'Ivoire and the Dorotea Gold Project in Eastern Chad. The plan is to keep the core lithium business, but change the name from IRR to Atlantic Lithium and to demerge gold into a company called IronRidge Resources Limited. Vincent Mascolo, CEO, has done an excellent job at driving this mining and exploration business forwards over the years. And Vincent joins us live from Australia. Good evening, Vincent.
Good evening, Donald, and good morning from where I am in the world. Thank you for having me tonight, this morning.
It's our pleasure. Now, are you going to take it away from here for us, Vincent?
Yeah, certainly. Thanks very much, and welcome everyone that's watching this evening in London. IronRidge Resources is a diversified explorer and developer throughout Africa. Our commodity of focus is gold and lithium, and today I'll be talking about unlocking shareholder value through the demerger of our suite of gold assets in Cote d'Ivoire and Chad into a separate, fully funded gold-focused entity called IronRidge Resources. And then I'll be touching on the rebranding of IronRidge into a pure lithium-focused entity called Atlantic Lithium. Here is our disclaimer. Please read that when you get a free moment. The corporate snapshot as IronRidge stands at the moment. The key takeaways from this slide are we have significant, like-minded, visionary and supportive shareholders, and we welcome Piedmont Lithium to the share register. We also have management is heavily invested into the company, which is always a positive, and we also have a very healthy treasury of $28 million US, and we have no debt. As Donald suggested, we're African focused. The key areas that we operate in are Ghana, Cote d'Ivoire, and Chad. We're domiciled in Australia. We're listed on AIM with the ticker IRR. We recently listed on the OTCQX markets, and we have made 3 discoveries in 3 years, and it's those discoveries that are now creating 2 separate focused entities to drive shareholder value moving forward in the coming months. Look, this is a very busy slide. I'm not going to labour on it too much, but our first discovery is the Vagwa Lithium project in Ghana, which is now fully funded production through Piedmont Lithium's investment of around $102 million US. And we actually have the same ambitions under what will be the RICA banner to deliver the same again with our 2 flagship projects, the first one being Zarano in Cote d'Ivoire and the second being Dorothy in Chad. Touching on our first fully funded discovery, which will form the backbone of Atlantic Lithium, and we'll touch on that later. Vagwa has a modest maiden mineral resource estimate with robust economics, and on that basis, we have been able to secure a fully funded development package via Piedmont Lithium. We have fundamentals support very robust scoping study outputs. With an initial mine life of 8 years, we've delivered robust economics, and from the pit layouts in pink, which you can visualise that the majority of our lithium-bearing pegmatites are outcropping, making for very attractive operating costs, capital costs, and impressive life of mine revenues. We're in pole position to service the US and European markets, and we've shown that through the investment with Piedmont. But we have exceptional geology, metallurgy, mineralogy. We have industry standout logistics. We are 1 kilometre from the national highway. We're 110 kilometres from the deep sea port of Takoradi. We have multiple high voltage power lines running adjacent our site. We have a very simple processing flow sheet, and we have pilot tested all our materials through ANSTO to produce high quality battery grade lithium. As you can see, our lithium project in Ghana, Awoya, is ideally located about halfway between the capital Accra and the deep sea port of Takoradi. We have significant exploration upside. We have only explored 13 square kilometres of our 684 square kilometre tenure package to date. Drilling is ongoing, and we'll talk a little bit about that in the next slide. As you can see, from our resource modelling to date, we're now targeting a resource upgrade in excess of 20 million tonnes. As you can see from the black outline, that is the current resource of 14.5 million tonnes. None of the yellow outlines have been included in that resource, and they will form part of the next resource upgrade, which I believe will come under the Atlantic banner. And there are also other areas that are not included in this slide. So we're very hopeful that we will deliver further significant resource upgrade and even better financial economics in the coming months. Moving on to our gold portfolio, here you can see what will form part of the gold demerger. Gold in Cote d'Ivoire and Chad will soon come under the banner called IronRidge Resources. And obviously, as we said, our lithium portfolio in Ghana and Cote d'Ivoire will come under the banner Atlantic Lithium. So touching on our portfolios in Cote d'Ivoire, Zarano is obviously our flagship project, and we believe that this will underpin the initial IronRidge Resources valuations moving forward. We also have a very impressive tenure package called the Vagwa Portfolio over to the central west of Cote d'Ivoire. This package surrounds Tieto's roughly 3.4 million ounce deposit, and this is also a drill ready target for the company, and we plan on drilling that early next year. Then we have also our Kineta portfolio in the northeast. This is more of our early stage, and we believe this will produce another pipeline of discoveries in 2022. Zarano, as I said, is our flagship project in Cote d'Ivoire. It spans some 47 kilometres of tenure package, and as you can see in this picture here, it's a highly weathered zone, which effectively will form part of our early ounces strategy. So from surface to 50 to 90 metres of weathered profile, free dig, early ounces strategy, which will underpin the valuation moving into 2022. As I said, we've got a 47 kilometre strike corridor defined with some 16 kilometres of hard rock artisanal workings at Zarano. We have 4 main areas of focus, which will deliver a maiden mineral resource estimate in early 2022. And those 4 areas are Owasso, Mbasso, and what we call the coffee bean structure, and obviously Yakase to the southeast. You can see the drilling highlights there on the left-hand side. These are very impressive grades, but the key takeaway for us is the grades at depth. So we know we've got mineralisation in the top 0 to 90 metres, but in the fresh rock, we are also hitting significant grades, so 24 metres at roughly 13.5 grams per tonne from 136 metres, etc. I won't go through these highlights, but these are very impressive grades which will underpin the valuation of Britain moving forward into 2022. And as I briefly touched on, we have an impressive tenure package around some 1,100 square kilometres surrounding Tieto Minerals Abuja 3.4 million ounce deposit. We know that the gold-bearing geological structures run along strike north and south into our project area. This is now drill ready, and we'll be looking to put the drill rigs onto that in early 2022 as well. So a lot of stuff happening in early 2022 under the fully funded banner of Rika Resources. In Chad, this is our longer term strategy, but a very impressive portfolio we have in Chad. Here you can see Usman. He's a geologist on secondment from the Department of Mines in Chad. He is channel sampling our first trenching program at Dorothy, and Dorothy is obviously our flagship project in Chad. We have a large-scale mineralised province in Chad. Our tenure lies within the Sub-Sahara Metacraton, with a potential analogue of an intrusive-related gold system. Our artisanal friend down in the bottom right-hand corner, he is manually beneficiating and sorting gold-bearing rocks, and his tailings are running to date at around 7 grams per tonne. So we have very much high hopes for Dorothy and the broader portfolio in Chad. But as I said, Dorothy is our flagship project in Chad. We have a 149 square kilometre licence granted over the Dorothy prospect. We have an anomalous footprint of approximately 3 square kilometres. And as you can see from the other images, there's the trenching that you can see in the bottom left-hand picture, and some of the nuggets that we've extracted through our trenching program. The picture in the centre, you can actually see the sheeted veins, and we're quite excited, and we're looking forward to, once again, drill ready, and hopefully we'll have the drills turning there in early 2022, probably late January or February. As I said, Dorothy is a significant discovery for IronRidge, which you can see the blue outline is the main vein zone, as we call it. And luckily for us, we have multiple repetitions of this main vein zone. There's some of the highlights on the right, but we have several repetitions. You can see them going through parallel to the main vein zone. And that is 3 kilometres long by 1 kilometre wide. That is quite an impressive anomalous footprint, and we look forward to putting the drill rigs into Dorothy early next year. Here you can actually visualise that we've got such a significant tenure portfolio in Chad, and we have across the Dorothy, Gueria, Clarke and Nabake tenure packages, we have in excess of a 40-kilometre strike zone, and we're looking forward to sinking our teeth in that. You can see the picture there with the artisanal workers beavering away, extracting gold from surface. A totally different regolith than what we're seeing at Zarano. So this will also hopefully deliver a coherent and continuous mineralised structure as we start drilling in 2022. So look, that's pretty much our package. Just a quick overview of our business model in IronRidge, and it was ideal to give you an overview of the projects ahead of talking about restructuring to unlock the intrinsic value for all shareholders. And as part of our exploration business model, originally it was designed to minimise risk and maximise the potential of delivering multiple company makers. And we have done that through our first discovery, the Awoya Lithium project in Ghana, which is now fully funded to development. And we hope to emulate that through this demerger. So unlocking the intrinsic value of our portfolios, Rika Resources will take ownership of all the gold assets in the House of IronRidge, and IronRidge will be appropriately branded as a pure lithium play, will be called Atlantic Lithium. We have delivered our first company maker, soon to be called Atlantic Lithium, and we hope to emulate that. With our gold initiatives under the new banner, Rika Resources. So, touching on the timeline, proposed timeline, terms, and demerger capital structure. Look, I won't go through the timeline, but I will touch more on the terms and capital structure moving forward for Rika Resources. So, existing shareholders, as of a record date of the 23rd of November, will be entitled to a 1 Rika share for every 8 shares held in IronRidge Resources. And then on that same record date, existing shareholders will be afforded a priority offer in Rika Resources. So what you will actually get is the opportunity to hold exactly what you have in IronRidge, soon to be called Atlantic. You will hold exactly the same. You have the opportunity to hold exactly the same interest in the newly formed and rebranded Rika Resources. It's a very compelling story. So what we have is IronRidge is forwarding an initial cash injection to Rika Resources of 7 million Australian dollars. And under the priority offer, which is now fully underwritten by Canaccord Genuity Australia, we will receive a further approximately 7.2 million in funding. That will give us a cash balance post-priority offer of roughly 14.2 million before costs. And we will be going to market effectively with a cash balance of 14.2 and a market cap of around 14.3 million Australian dollars. So it's a great opportunity. We're staying private in the short term to allow us to drill these assets a little bit further, and that will surely underpin a spectacular valuation once we identify a recognised exchange moving forward into 2022. So moving along, what we see here is this is what your IronRidge will look like, hopefully post and subject to shareholder approval on Thursday, the 18th of November 2021. We'll be charging the change, and we'll be the first lithium producer, we believe, in West Africa. From a corporate perspective, not much really changes from IronRidge to Atlantic, other than the transfer of $7 million from IronRidge to be called Atlantic into Rika Resources. Sorry, it's a bit of a tongue twister, but the investment case is still compelling. Nothing's changed. Same capital structure, same shareholder base, and the investment case is getting stronger and stronger by the day. We're accelerating the projects to production. Drilling is ongoing. We have multiple drill rigs on site. Studies and permitting is underway. We'll have an impressive lithium portfolio incorporating our 774 square kilometres of tenure in Cote d'Ivoire. We're fully funded, as I keep saying, to production via the Piedmont investment. We have a strong cash balance of 22. We will have a strong cash balance of $22 million US. And we have significant exploration upside, as we've only explored 13 square kilometres of our 684 square kilometre tenure package. And we have strong ESG credentials. 98% of our staff are Ghanaian nationals with a low carbon footprint. I won't dwell on this, but this is a snapshot of what we've already rehashed in respect of our robust economics from our Vagwa lithium pegmatite discovery. And we look forward to updating the market with our resource upgrade and upgraded scoping study under the Atlantic Lithium banner in the very near future. So post the demerger, this is what Rika Resources is going to look like. once again, subject to shareholder approval on the 18th. However, the capital structure, which everyone will have the benefit of, is very impressive. Tight capital structure with a market cap of around 14.3 million at 10 cents. That means if everyone follows their money, your average buy price is around 5 cents Australian. And if we are to list, say, on the Australian Stock Exchange at some point next year or any recognised exchange, you will see that there will be a significant re-rate on that entry price at that entry price in the coming days. So the investment case is strong for Rika Resources, fully funded, fully cashed up to the tune of 14.2 million Australian dollars. We are already well established, being in Cote d'Ivoire and Chad for 4 or 5 years, and we are hugely undervalued on these portfolios alone. So Zarano and Dorothy will certainly underpin our valuations moving forward under the Rika banner.
Okay, Vincent, one more minute, please. One more minute.
And please meet our teams throughout Africa. As you can see, there's the Ghana team, Cote d'Ivoire team, and our Chad field team. Thank you very much. I welcome any questions.
Vincent, thank you very much indeed for that. What do you need holders of IRR stock to do on Thursday, the 18th of November? Presumably now, ahead of 18th of November. What are you asking them to do?
Well, they can either buy shares to get on the register and be on the register by the 19th of November, or they can hold their stock. And then they will receive the 1-for-8 shares, and they will also receive a priority offer to buy further shares at a very low price, entry price.
Okay. So when does IronRidge become Atlantic Lithium? When does that happen? And do you know what your new ticker might be? And in broad terms, what happens next?
Okay, so post the AGM, we will post an AGM in favour of the resolution, which is on Thursday. I think it'll take probably 3 or 4 days for that to actually take effect on the boards. The ticker will be ALL, ALL, Atlantic Lithium. And look, we're now Atlantic Lithium being a fully funded discovery. It's now focusing. It's focusing on putting a project into production. So we've gone from explorer to developer to now taking a project into production. So and with a healthy treasury of 22 million US, we've got a lot of money to spend on initiatives and further exploration initiatives on our Cote d'Ivoire portfolios, Cote d'Ivoire lithium assets, and any other new opportunities that might present themselves.
To what extent are you exhausted? To what extent are you delighted? Or is it simply a combination of the two of those extremes?
We're probably both, and frustrated to see the share price labouring at this level. When you do a peer comparison, our nearest peer is ASX listed and has a market cap of near 4.5 times us. So, look, hopefully the rebranding, becoming refocused as we move to development, put a resource upgrade out, update the scoping study, and as we advance the studies into the new year, hopefully we can add some additional comfort to the AIM market.
Okay, Andrew Adams asks a question. He asks, what's the current level of purity of the lithium tested by ANSTO? The last numbers I've seen were 99.92% back in January 21. Are these figures high enough for the EV market?
Yeah, absolutely, they're high enough for the EV market. But we're producing a spodumene concentrate, which will produce a premium product. Somewhere repeatedly, we're getting in excess of 6.3% lithium oxide. So we'll be able to command a premium price for that product. But what we did want to display to market is that our product can produce a premium battery grade lithium. But the purity is also by virtue of that we have low deleterious elements. So we have low iron, low phosphate, and that's what also complements a high purity product.
Okay. A couple of people have asked about unlisted shares. This is bad news, I'm afraid. Brace yourself. Their brokers are unable to handle unlisted shares, basically, says Jack Turkis and Martin Orr. People at Hargreaves Lansdowne, who are one of the UK's larger brokers, they're unable to provide access to the priority offer, for one. Okay, he just says that there are issues. I'm more than happy to send these 2 emails on to you offline. Do you have any thoughts on that?
Get a new broker. Look, I don't think it's as complicated as people think they are. Everything goes through DI, and the nominees should be able to manage the process. But also, look, we'd encourage people that are keen and interested to contact us directly, and we will see what we can manage. But technically, the nominees should be able to manage this process. But in respect, if you are on the register and we can prove that you are on the register, there should be absolutely no reason why you should not be able to receive a share certificate from Rika Resources, and then we can manage that process together in 2022 as we move forward onto another exchange.
Got that. Good man. I'll put those people in touch with you. Andrew Adams asks, what further steps need to be taken before you actually mine the lithium at Iowa, and what are the timescales on that? Okay.
So look, we're very advanced. We're almost 2 years through our environmental monitoring cycles. So we're midstream studies, and we're preparing for permitting. So we think that we can be in production by no later than 2023, in short.
Okay. Josh Cole says, why do you believe the share price has seen little sustained positive movement in the medium term, despite reasonably consistent news flow? I know you've stated before you believe a fair value would be 50 pence minimum. What's suppressing this?
We were hoping you were going to tell us that, Donald, because we have no idea. Everything's right about this project.
It does seem to be.
It's standout. It's exceptional metallurgy. It's exceptional geology, second to none in respect of proximity to operational infrastructure. It's a developer's dream. The resource is growing. You only have to look at the last 3 announcements we put out with drill results to know that this resource is going to grow significantly. We don't understand it when our peers in Australia have 4 and 5 times multiple on our market cap. We don't understand why the market's not appreciating it. But look, the reality is we have a very strong shareholder. We have a very strong shareholder base through our major shareholders. So no one can come to us aggressively to try and pinch the company. And we're fully funded. So look, we're just going to keep delivering. We're just going to keep ploughing through all the noise, and hopefully the market will appreciate in time what we're doing and what we're about to achieve.
Indeed. Okay. Michael O'Brien asks, or he says, thank you, Mr. Mascolo. It's always nice when they're polite on the way in. Can you tell us if and when the Australian management team are moving to Ghana? It seems difficult to manage remotely.
No, that's not the case. We have exceptional teams in Ghana, as 98% of them are national. We have Ewan, as you can see on the last slide there. He stands out. He's our Welsh exploration manager. We have weekly team meetings through Zoom with our technical meetings with our teams. And look, I think, to be honest, we'll all start travelling early next year once Australia's regimented COVID regime lifts. But no, everything is operating smoothly, and my recommendation is to any current shareholders or potential investors, watch this space over the coming weeks.
Okay, talk us through the deal with Piedmont Lithium. It was announced in August. It fully funds the project to production, the lithium project to production, for $102 million. Talk us through that. Perhaps that'll get the investors excited.
Yeah, look, that's a great deal for the Vagwa project. Piedmont Lithium's investment is is clearly an endorsement of the project and the exploration upside that it will deliver in the coming months and years. So Piedmont, it's a three-stage process. First stage is complete. They invested $16 million into IronRidge Topco. That will fully fund Atlantic Lithium moving forward. Stage two is that they need to spend a combination $17 million to advance the Vagwa project to DFS. We are already spending that money aggressively, progressing studies, expanding the resource, and we have a minimum DFS criteria. So we believe by virtue of the scoping study that criteria is already achieved. And if Piedmont Lithium elect not to proceed, then we get to buy everything back for $1. So low risk for investors. But basically, this transaction means that IronRidge shareholders and investors get a 50% free carry, 50% of the product we maintain. We've given away no rights to our product, and there's no further risk. So we won't be raising any capital. There's no further dilution, and we're building a project to basically share in revenues greater than 1.5 billion life of mine. So this is a great opportunity to be in. I mean, if we had to do this ourselves, then everyone would be crying, "Oh, capital raising on the horizon again," etc. Well, we've taken that angst away. It's fully funded. There's no more capital raisings, and there's no debt. So there's no risk.
Vincent Mascolo, thank you very much indeed. We're out of time. Very grateful for your time, Vincent. Very grateful for all the questions. And thank you very much indeed for getting up in the middle of the night and speaking to our investor audience. Our next company is Advanced Energy, created by an experienced team of oil and gas specialists in February 2020. The first acquisition for Advance is a 50% farm-in for the B10 well on the Buffalo field on Timor East, an island close to Indonesia and off the coast, northwest coast of Australia. Advanced raised £22 million for the buy-in in April. This was a previously producing field and has the potential to produce, I shall say this very slowly, 40,000 barrels of oil per day, of which Advance get 20,000. Leslie Peterkin, the CEO, joins us from Geneva to update us on the latest news from Buffalo. Good evening, Leslie.
Yeah, hi, Donald. Okay, well, look, welcome everybody. I understand there's quite a nice audience here today, Donald, so that's very good of you to have arranged all of this. Yeah, I'm the CEO of Advanced Energy. We started 18 plus months ago, so we're still pretty young, pretty ambitious. We've got an intention to grow the company quickly through the style of our particular strategy. And I don't know how much detail I really need to go into, but let's just try and run through this deck. And actually, personally, I'm rather more interested in hearing questions and answers, which usually helps me understand what people really want to know. So can you move to the next slide? Donald? Hello? Okay.
You need to move yours.
Oh, I thought you were driving. Sorry, I beg your pardon.
No problem.
Okay, so so here we are on our vision, which is the first slide, and I think I've more or less covered it. We're a very experienced team, and I'll talk a bit about that more. We've got a strategy which we think is quite innovative and how shall we say, novel in terms of the way we want to go. We want to particularly be involved in assets where we can unlock value that others may not have seen, or assets that have been overlooked, what we call the unloved assets, and we want to be non-operated. So we want to be a small team which is G&A effective, managing a portfolio of assets that are non-operated with operators that we believe we can engage with constructively to move these assets to maximize their value, and we're particularly interested in having two-party joint ventures where it's simply ourselves and the operator, so that we can influence through our experience the optimization of the value of the assets. We have a sort of notional aspiration to do more than 20,000 barrels a day by mid-decade. Personally, I don't think that's necessarily that ambitious, but clearly we're not there yet, so I won't say any more about that right now. In terms of corporate overview, I've touched on experience. This number at the top here, 120 years, is probably not correct. It's probably more than greater than 150. We're 6 people in the company, all on the board, and I think on average we probably have about 30 years experience. So we have a lot of experience to bring to this endeavor, and it's one of the things I like to talk about quite a bit. Our business is a risk business, and it's only through experience that you get used to and have the ability to manage risk. And we believe that given the experience we've got and the breadth of experience internationally, covering many disciplines, that we're well placed to deliver on our aspirations. And we believe in ourselves. We have 5% of the company at the current time, and it's quite likely that we'll put more money in at a later stage as required. We're certainly very willing to do that. I mentioned about the novel strategy for growth. We're targeting only discovered resources. We don't do exploration. And this is something we came up with before we even started the company. And it's not specifically related to an ESG requirement. It's something that we wanted to do from the outset. We don't want to explore. That's where money gets burned and lost. We want to be in discovered resources where we can add value and take them forward to either where they are now developed and beyond, or get them developed where they've been languishing and undeveloped. And I mentioned about how credible partners. Obviously, we don't want to get into a two-party joint venture with people we're not comfortable with. That goes without saying. Our first asset is one we identified before we started the company, or desire to get into. It was the Buffalo asset which is located now in East Timor. We can talk about that a little bit later. The operator is Carnarvon. Of course, I just mentioned I was in Australia. I was 10 years in Perth, and there I got to know a lot of the assets in this region, and I've worked a number of important assets in this particular area. So I know the reservoir well, I know the circumstances well, and I'm very comfortable with Carnarvon as an operator. We think they're highly capable, and working together as a team of 2, because we're 2 parties now, both 50%. And the Buffalo asset itself has a 2C resource that's been certified at 34 million barrels. And that's what we're aiming to move to reserves with the B10 appraisal well that's due to be start drilling this month. And as you mentioned, Donald, previously this field was produced and developed and produced by BHP and Nexen. And when it came on production, 2 wells produced a total of 45,000 barrels a day each. A very prolific reservoir with a very high recovery factor capable, which is known in the region. And we are also in the business of growing the company. And when we started the company, we brought with us a number of assets that we're chasing. We've since then grown that portfolio of potential assets, and we are actively engaged in running forward some of these assets to hopefully another concluded deal, I mean. Here is the Buffalo FPSO of before. This is what we will be putting in place in due course, we hope, once we've drilled this well and proved up the reserves. You can see the very flat sea state out here. And this is in the Timor Sea, and this is very typical of what it's like there. We are not in the cyclone zone. You hear about cyclones in Australia. We're not in that zone. The history of the field, I mentioned, it's BHP and Nexen were involved in its development about 20 years ago. It produced 21 million barrels over 5 years from primarily 2 wells. And those 2 wells originally produced 45,000 barrels a day initially. They both produced 8 million barrels each, as it happens. So they were very prolific and very valuable. Production shut in 2004 after the 5 years at 4,000 barrels a day. That was related to facility issues that weren't foreseen at the time that they developed the field. And of course, we won't necessarily have the same problems. We can learn from the past. And in terms of the location, you see a map on the right-hand side. The very small one shows the East Timor, the Timor Sea, Darwin on the right, the block on the in the middle there, and the map underneath that shows the new maritime boundary, the blue line, that was agreed in 2018 between the 2 countries. It was a long-standing issue that needed to be resolved. It has been resolved now, Previously, the area was managed both by Australia and East Timor. Relations between the two are very good. And right now, as it happens, you can see that the Buffalo field, the pinkish area with all the reticular blocks, that was previously the Australian boundary, and that the Buffalo field has moved to the right-hand side of the blue line, so it's in East Timor now. We're very happy with the idea that it's in East Timor. The East Timorese are very, very keen to get their assets on production. You can see the Bayundan field just on the bottom right there. It's about 100 kilometers from Buffalo. I was actually involved in developing that field. It's a very large gas condensate field, and it's still producing at this time. In terms of lower operating costs, instead of operating costs, in Southeast Asia, obviously you expect to be able to have lower operating costs, so that's all very helpful. The PSC terms are very good, the best in Southeast Asia actually, but they've actually been enhanced by the fact that the field moved into East Timor, because the East Timorese, according to the Maritime Boundary Agreement, the East Timorese have to keep any asset that moves into East Timor fiscally whole. So in other words, it's essentially the Australian system, but it's been converted into the PSC, and the PSC was enhanced accordingly. So in fact, in East Timor, the Buffalo field has the best PSC in East Timor itself. How have we got to the point where we're looking at this asset 20 years on? At the time that it was developed, it was understood that there was an undrilled crest, or attic as we call it, the highest point in the field, if you will. And 3D reprocessing of today, 20 years on, has been able to delineate that much more clearly. And we have 2C remaining oil in place as a result, certified at 85 million barrels. In terms of the farm in itself, I won't dwell too much on this. I think you touched on it, Donald. The deal was that we would join in the asset at 50% with Carnarvon, that we would pay for the appraisal well that needs to be drilled up to a certain cap, which was $20 million. And then we would seek to secure the funding for the development 100%. And the net result of all of that is, if you look here, in the third blue bullet point, we have the first year of free cash flow at $50 is very close to $300 million. And that's based on the CPR economics of risk. That's nothing to do with what we calculated ourselves. And 70% of the gross cumulative cash flow is recovered in the first 2 years. Essentially what we have here is a very high rate producing reservoir with a modest volume of oil, and you combine the two and you get a huge amount of cash flow in a very short time. Coming to something that's probably quite interesting for people to try and understand a little bit better what's going on. If we look at the map here, this is a notional, it's not the exact situation, because obviously we're going to drill this appraisal well, Buffalo 10, where the black dot is. But this is one realization of the remaining oil column, and the green area, shaded area, is where we see the undrilled attic or crest that I mentioned earlier, and the Buffalo 10 well is being drilled essentially smack in the middle of that. And that is, in effect, the location. You can see to the left and a little bit up to the top, there are little black lines going out to well numbers, and which are the downhole numbers, downhole locations of the previous development wells. The point being that those wells didn't penetrate the attic, and the attic is therefore there to be delineated with this well, and then we're produced with probably 3 development wells. The objective is effectively to find an 80-meter column. Interesting to note that the 2 best wells I mentioned earlier that produced 8 million barrels, they actually only penetrated a 55-meter column. So in other words, even if you don't know too much about the oil business, you can anticipate that we're going to get more per well in an 80-meter column than we would in a 55-meter oil column. We're in very shallow water, so it makes it easy for us to drill wells. It's relatively straightforward. We're not in deep water. And that also helps with the development, which can be very simplified. The well design is copy-paste of many other wells that have been drilled in this area. So there's nothing really to be concerned about that. It's a 30-odd day well down to about 3,500 meters. So it's fairly deep, but again, it's normal here. There's nothing unusual. The key issue is we have high impact for low risk. That is really the message here. The mid-case recoverable, I've mentioned several times, 34 million barrels. It's 2C now, contingent resource until we drill the well. Then we want to convert it to reserves. And risk have in the CPR estimated independently that there's an 85% probability of confirming a sanctionable development based on the minimum economic field size. So it really doesn't get a lot better than this. There is residual risk, and that's why we're drilling the well before we commit to a development. In terms of redevelopment concepts, pretty straightforward. On the right-hand side at the top, we have the FPSO with the wellhead platform and shallow water. That was what was done before. If we get 34 million barrels, almost certainly that's the way we'll go. If we are unfortunate and get down to the lower end of the developable resource reserves, then we could consider a MOPU on in the shallow water with an FSO out in the deeper water. But that's not what we expect to happen, because that's not what we're drilling for. Three-well development is the approach that we consider is likely to provide the optimum recovery. Wellhead platform 4-5 slot, very similar to what was done before. We hope to take FID somewhere in the early part of 22, let's say around about the middle of 22, because we're a little bit later in drilling than we had anticipated. Schedule standard for this kind of asset or opportunity, development opportunity, about 18 months from FID. So that puts us with first oil at the end of 2023, which is our target. In terms of CapEx, we're less than $4 a barrel, which in today's world is pretty darn good. And this was again certified by Risk. In terms of deliverables, I mentioned high recovery factor before. 60% is not unusual in this area. Laminaria, Corallina, Khitan, other small oil fields in the area have very light oil and high recovery factors. And we have 53 API oil, which is similar to what's found elsewhere in the region. Around here, 63% of the reserves are produced in the first 2 years. That goes back to my point about a modest volume of reserves with a very prolific reservoir. So life of the field is 5 to 6 years. We get it all out in a very short time. Very quickly onto economics. I won't go into detail on this. Focus on the top right-hand side with the table there. These are net numbers to advance, 50%. And you can see the CapEx, the cumulative cash flow, the NPV and IRR, and payback time. Payback in pretty every circumstance is less than 12 months. So in the first year, the asset pays back in all of the scenarios that we've been working with Risk and ourselves. The cumulative cash flow, for example, at $50, all these economics are at $50 oil. The cumulative cash flow for Advance is close to $300 million, and that's a large number by any standards. The NPV, again, approaching 200, the IRR 100 or more about or thereabouts. Certainly, if you assume that we're at $70, I did a quick calculation, these numbers go up by 50%. It's very, very sound economically. Just going over to the left-hand side there, maybe look at one case, the case where it says the second last bullet, the 1C case. That's the what we would call approved. Say we are in that lower P90 case. That case itself is economic at less than $35 a barrel. So you can understand why Risk have estimated that 85% probability of a sanctionable project. Touching on ESG, this is a modern version of a lot of things that have evolved in the oil business. We do a lot and have been regulated very heavily environmentally in the oil business for many, many years. So that is not particularly new. Doing societal has been something that's been part of the business for many, many years as well. I've been in the jungles of Africa and Asia, putting in clinics and schools and so on and so forth for local communities, so that we give something back to those countries' population. From my point of view, we are always a guest in people's country, and we do the best by them that we possibly can. Just want to move on so I don't run out of time here, Donald, but I think I must be doing reasonably well because you haven't interrupted me so far. Last slide here, our investment case. We're a strong board with a management team, as I described. We've got 6 people, all with 30 or thereabouts industry experience, years of experience. And we also have supporting us the Exodus Group, who provide, through an MSA that we have with them, established with them, ongoing and continuous technical support, both on the subsurface side and on the surface side. And that's working extremely well and keeping our G&A low. We have a proven ability of identifying and executing high value adding opportunities. It's a nice statement, but we also have some track record cases on our website. I encourage you to have a look at those. We're not actually saying we can do this. We've actually done it. The B10 well is November time due to start drilling, and in the parlance of the industry, of the market, sorry, value catalyst is extremely material, and what we are about in advance is about materiality. That is what we want to be doing. And the B10 well, of course, is very high impact for us. It is our first asset, but we have others in mind, but we can't talk about those, of course, until we're well advanced. I've mentioned the 34 million barrels, the high rates of return you've seen for yourself. I'd encourage you to look at the CPR. It's very comprehensive, and all those all the values in there are independently carried out by risk. We're well established. I would say the go-to certifier in Australia for sure, but they also have a base here in Europe. And we are targeting, as I said, cash flow generating projects, and we're working on those in parallel with getting Buffalo off the ground. Did I do well?
You did excellently, Leslie. What a star you are. I'll be perfectly honest, you have answered all my questions. That was very comprehensive. You did extremely well.
I hope I wasn't speaking too quickly.
No, well, I'm a Scot, so I understood you perfectly. I certainly understood. My goodness, what an exciting prospect, yes?
Absolutely.
Even you must be excited by this, Leslie.
I'm always excited.
No, but this is particularly exciting, isn't it?
It is. Well, I think it was particularly exciting to cut the deal with Carnarvon. I mean, it had been out there for a long time, and they were very resistant to doing a deal that wasn't exactly what they wanted. And in the end, we came up with a formula that met their requirements, and we got the deal. It was actually had been on farm out, if that's the right term, for nearly 2 years before we got the deal. So yeah, we were really pleased about this one.
It's always good to have a house which hangs around for a wee bit, don't you think?
Well, yeah, I mean, there is an element of that. We quite like picking up stuff that other people don't want or can't get.
Now, Matthew Stott asks the question that we're all asking, to be fair.
When are we going to start drilling?
Of course. When's the Spud?
Well,
Matthew Stott, there you go. There's your name, Jeff. When's the Spud?
Yeah, when's the Spud? I mean, let me put it this way. It's out of our control when we get the rig. It should be clear to everybody. So the rig is currently with Jadestone, and it was due to be provided to us through the contract that we've got with Valaris somewhere after the middle of October. And we had anticipated that it would perhaps be in the first half of November, but in the end we said sometime in November. And as time has gone by, they have just obviously had problems. We don't know what their problems are, but they've kept plugging on. And at the moment, the latest date I have is towards the end of November. So we're not anxious about that. We'll get the rig. We're going to drill a well. It's just a little bit disappointing. Probably means I'm going to get the logs on Christmas Day or New Year's Day. Oh
no, that's not good, is it? That isn't good. Now,
it happened to me before.
Lordy. John Zadkovich asks an equally excellent question. For Leslie, he says, with one good asset under your belt, we can't deny that. It's a fantastic asset. In a jurisdiction some have found challenging, where else is the company interested in acquiring discovered assets?
Right.
What have you got up your sleeve?
That's a very good question, and I didn't really touch on it too deeply. We have, as I say, 5 tenets to this strategy, and one of the tenets is that we're non-operated, as I said. And one of the things about being non-operated means that we can focus on getting value assets and not trying to create a core area. You hear many companies saying we've got a core area here or a core region or whatever. We have that flexibility that if somebody comes up with an opportunity, presents us an opportunity in a place where we don't happen to be, then if the asset stacks up, the country fiscal system stacks up, and they stack up as an operator, then we can parachute into that company in a matter of weeks or months, depending how long it takes to cut the deal. And if it's only one asset in that country, we're not concerned. We're not building a portfolio in necessarily country. We're looking for value assets. So it's something that maybe people don't quite get. As an operator, that's not so easy. You have to build up a team, you have to build up an infrastructure that drives you to that core area aspect, and then you try to optimize the use of your personnel. We don't have that restraint. And come back to region, we've more or less decided that certainly North America is out because there's too much competition and knowledge that we don't have. South America, possibly maybe, we have experience in the team in South America, but right now we're not looking at anything specifically there. Anything essentially in the Eastern Hemisphere is what we're looking at, except for China, Iran, and Russia. And we're looking at assets in lots of regions. We're interested in the Middle East, we're interested in Africa, we're interested in Central Asia, Asia in particular, because I've worked a lot in Asia. And
Leslie, I'm going to interrupt you there. That's a long list. Could you narrow it down for us? Is there one specific project you're looking at right now?
There are two projects that are we're very hot on at the moment. Let me put it that way.
How much can you tell me about those two hot projects?
Not a lot.
Darn, it's all going so well.
No, what I want to try and explain is that we have a very large field of potential opportunities. We're not restricted.
Is it possible to find something almost as good as the East Timor Buffalo field?
Yeah, I would say that that's pretty much a one-off in many respects. And that's not just to say because it's the first asset we've got. I mean, you've got a conjunction of technical aspects that come together here, which is pretty unique. I can make some technical terms here without hopefully boring everybody. We have a Darcy reservoir. It has 90% net to gross. We have a very, very slippy oil. It's 5 times slippier than water. We have an internal water injection system. We have a massive aquifer that's pushing that water out, that oil out, sorry. And that's what gets this prolific reservoir with a very, very high recovery factor. So
the technicals on Buffalo are excellent from an oil person's perspective.
You've got everything you dream of having here, virtually.
Good Lord. Now, Dave Westlake, he's not satisfied with the answer of first production by the end of 2023. He says, could this timeline be accelerated? And what's the possible best case scenario? He's asking the CEO to put his head on the chopping block.
Well, I don't want to get it chopped off, so I'm going to say I can't beat 18 months. I think it's very hard to beat 18 months from FID on this style of project. I've done several of these in the past. When BHP did the development, they did it in 15 months from FID. They're BHP, we are not BHP.
Okay, Stefano Bruscioni has just asked an interesting question. The Buffalo success will re-rate the shares, our shares, he says, so he's a holder, significantly and simplify funding for new deals. In this respect, what funding solutions do you see for new deals which might be non or less dilutive?
I think we're going to look for debt. And we have a very, very experienced CFO in Stephen West, who's he's Australian, but has lived in London and been in the market seeking funds for various companies in the past. We brought him on board because he's a specialist in this area, and we expect to be able to raise debt against some of the assets and opportunities we're looking towards at the moment.
And this is, sadly, it might be our last question. It's a cheeky question from John Patchett, but not a bad question, but nevertheless a cheeky one. Clearly, we all hope the Buffalo will succeed, but what happens to the company in the light of the 15% case that it might not?
In the 50% of the case that it might not, well, first of all, I would say the chances of us not having a development are very, very, very small. It would be almost unimaginable to me that we don't have a development. I'll be perfectly frank with you about that.
Wow.
And that's not me. I mean, it is me saying, and that's why we wanted to get into the asset, but it's been verified by Risk through their CPR, which is an independent piece of work that we can't influence. So I would say, don't think about failure, just think about success.
Okay, Alan Edmonds, much more positive. What grade of oil is expected?
Sorry,
you said what grade of oil is expected?
What grade? Well,
you said it was very slippy.
It's pretty slippy, yeah. It's I would actually call it. I've come around to calling it the champagne of oil, basically. It's 53 API. It trades at a premium to Brent of about $2, and we have a number of companies that are very keen, despite the small volume, trading companies that are very keen to get hold of it. So when it comes to raising funds for the development, we expect a lot of competition to get access to this oil.
Okay, my very last question. Carnarvon are a safe pair of hands, you said, Carnarvon Petroleum. Why so? Tell us a little bit more about Carnarvon.
Carnarvon as a company has been around a long time. The current team are all E&P veterans. I think they're a little bit younger than we are, which is maybe not a bad thing. No, they've been in the oil and gas business, their careers. They're involved at the moment in a very complex development called Zarano with Santos, much more complex than what we're doing at Buffalo, which is relatively straightforward in E&P terms. We're confident that they can deliver for us. And not only that, I come back to one of my early points. We're a two-party joint venture. We're 50-50. We have a lot of experience that we can bring to bear, and we're actually doing that in conjunction with them. We're effectively a joint team.
Leslie Peterkin, CEO of Advanced Energy. That was absolutely fantastic. Not overstating it. What an interesting story. Thank you so much for joining us to tell it. And as you may well know, Emmerson has been developing a low capital cost, high return potash mine project near Chemisset in Northern Morocco. We've been hearing about this exciting potash project for a few years now, but Emmerson have just secured significant investment funding for almost 47 million US dollars. I'll say that again, 47 million US dollars. That's a substantial sum of cash. And Graham Clarke and his commercial director, Charles Vaughan, will talk us through the development of Chemisset from this point onwards. Welcome, Graham. Welcome, Charles.
Thanks, Donald, and good evening to everybody. So we just moved to the summary slide, the first slide. I think just to reiterate what Donald's just said, we signed a deal last week and announced that. That really is a trigger and a game changer for us, because it allows us really now to proceed apace with the project. This sort of summarizes the highlights of the project. 1.4 billion net asset value. That was from the feasibility study, which was completed in 2020. But if you look at now the potash price over $800 a ton in some markets, that actually pushes the NAV up closer to $4 billion. So a very high value project. In terms of the output, the potash, there's an increasing demand year on year, and that will continue, and we'll cover that off in a slide in a moment. Very low cost when in production. Everything we've done to the highest standards in country in terms of the environmental and social governance and compliance. We have a very supportive country in terms of Morocco. All of the authorities are very supportive of the project. They see the benefits the project will bring. And with an initial 19-year life, with the opportunity to probably double that with the resource that we have a long life project here. One of the key things though, key development there in the top right-hand corner of this slide, we have the expertise in place. I joined the company last year with the sole aim of actually building and operating this project, and that is what we're focused on. I've got huge experience in the potash world, having operated the only potash mine in the UK, Cleveland Potash, for a number of years, and also have the development experience to take this project through into construction. So it's really key to understand that we are going to build this project, and the announcement last week actually really gives us the kickstart to be able to do all of the work now to take us into construction. This slide just sort of simply shows the reason for the increase in demand for potash. Increased population, yes, but crop production is outstripping the increase in population. That's due to the demands of the world's people who want a greater variety of food. And the potash demand increases above that because as we grow more, we deplete the potash, the potassium in the soil, and we need to apply more fertilizer. So typically, we're looking at an increase in demand of 1.5 to 2 million tons per annum for the product. So with our size project, which is under 1 million tons per year, plenty of room for us to come into the market. And even with people talking about BHP in the future, that will, by the time that comes into sort of first phase operations of 5 million tons per year, there will have been an increased demand, 3 times that in the market. The location, Morocco, we talk a lot about that. It's a great country, great infrastructure, but it's also worth noting that it is actually a fertilizer hub. OCP, the world's largest phosphate producer. You can see their mines there on this slide. They operated in the ports of Jos, Lusfar, Casablanca. So actually Morocco is already a country that understands fertilizer, the benefits of the economy, the needs for that. And it's a gateway to Africa for our product to be either used in Morocco or Africa as a whole. We did a socioeconomic study, and it's worth just focusing on a couple of these highlights here. Just under 2,400 jobs created, and that's in a part of Morocco where they're crying out for employment and good quality employment. So we have a transformational impact on the local economy with a 40% increase in the local GDP. So significant investments, and obviously this is very well understood in country by all levels of the government. We talk about our logistical advantage, and this slide just sort of summarizes that. So we compare shipping our product, MOP, to one of the main markets in Brazil, where currently the spot prices are well north of $800 a ton, and compare our cost of doing that to the cost of the incumbent Canadian producers in Saskatchewan. We've shown this slide quite a lot, but it's still just worth bearing in mind that with their costs, their royalties, their transport costs to the port of Vancouver, and then shipping to Brazil, compared to ours, we have over $100 a ton advantage in terms of the margin that we make on our product compared to them if we ship to that market in Brazil. Just on this slide, we summarize the difference between our project and a typical Canadian potash development. And the key things here, on the left, we look at the sort of CapEx implications. Our deposit is shallow. We can access that through 2 declines. There's no aquifers. So it's a low risk, low cost development to access the resource. And then we're very close to the port, so a very short journey to take the product to a port where there's excess capacity in Casablanca. And I was there recently talking to the port operators, and it's very clear they could accommodate all of our product and the salt as well that we want to ship from Casablanca. We've already talked about logistical benefits that we have. If you look at a Canadian potash project, $1 billion to sink the shafts, deep shafts through aquifers, high risk. We have a completely different project here, which is low risk and low capex to actually get into operations. So I'm over to Charles now, the next 2 or 3 slides.
Thanks, Graham. So we have to, apologies for all those who know this well enough and feel like we're going back over the same territory and you're seeing the same slides, but it is important. We have to assume there are new people listening. So this slide we've got here, I want to talk about this relative, for instance, to the last presentation we've just seen, which has an obvious massive catalyst coming with a spud. What we have is a very considerable NAV upside to play for in the equity. And the question is always, how do we go about closing that? With this deal we've just announced, we've basically de-risked a large part of the hardest part of the project finance, the hardest part being the project equity, the easier part being the debt. Of course, the share price has moved up well. We've gone to 7p. That's great. But as you can see here, you know, a $75 million market cap relative to a project NAV of 1.4 on the old long-term potash price still leaves a huge amount of running room for the equity. So what investors, unlike waiting for one big catalyst like a spud, what they're looking for here is a constant de-risking of the project. So we've had this very important piece of news come through on the strategic investor. And I think the next thing is to see how the rest of the financing falls together, and therefore how we can actually start accreting up to the 20–25% of NAV that I would expect a decent quality project to actually trade for in the pre-production stages. And we talk about decent quality. I'm just going to move my screen so I can see the Brazil spot price assumptions here. I mean, if we were selling our product now, we would be selling it at 800 a ton. The whole finance, the whole construction would be paid off in a little over a year. The project NAV, as Graham said, is $3.9 billion after tax. I mean, this is incredibly good numbers. Yep, we're not selling potash at the moment, but I can tell you it's certainly been very helpful in our negotiations with the strategic that the potash price has provided such a buoyant backdrop. And I would expect it to be helpful not only with the debt piece of the project, which we will start moving into right now, but also likely with the next tranche of equity, which would be the final tranche. So yes, not selling the product, but yes, also selling the investment in this backdrop is hugely important. And just to sort of clear up how the structure of this deal was arrived at. It took a lot of negotiating, and the merchant bank, GQC, who was negotiating on behalf of GSM, ultimately decided to co-invest with GSM. And the deal that we structured was, well, it's neat for us because the upfront equity in cash at 6p, it was a small premium to the then share price, fine. That is very important money for us because it enables us to do all of the work which otherwise would have been waiting on a cash infusion. The balance 40 million sits there waiting for the conditions precedent to be met. But the main one of those is that the whole project finance is put in place, by which we mean all of the project debt and the final tranche of the equity. So it sits there as a way of giving comfort to the project lenders looking at this, that we are going to have the whole piece, and therefore they do need to do their work and put in place their offers. And when the whole piece is there, we can draw it down. And the interest rate that a lot of people talk about, 9%, we consider that a perfectly good one. We would have preferred 2%. They would have preferred 18%. 9% is what would be payable for a maximum possible amount of time of 2 years. But in all likelihood, when all of the project finance is put in place, the NAV will close from 5% as it is now to more like 20, 25%. And the share price won't be 7p, but it'll be north of the 16p easily. In which case, all of these converts they have a mandatory convert on them, so they all become equity straight away after 1 month of that, and the interest rate stops. So the backdrop, the worst case scenario is that this runs for the maximum of 2 years and then converts at 8.2p. But the more likely scenario is that once all of the project is put in place and we're going into construction, the share price is a lot higher and these have become shares. So just to clear that up on the interest rate. And one of the most important things that isn't lost on anyone is the fact that by putting this deal in place, it accelerates all of our negotiations with the other project financiers. And I mean, primarily the debt funders, who is, they're the next port of call for us, but also, of course, the other parties in the data room who were interested in taking a significant piece of this company are miles more likely to come forward now. So rather than it being a question of us having shot our bolt with the most likely strategic, I would say it's actually become much more likely that a second strategic enters the fray. So yeah, for us, it's a wonderful deal.
Thanks, Charles. So what I'd like to do now is, I'm not sure what everybody wants to know is what we're doing next. So I just want to talk a little bit now about the project's execution. And this is preparation for this work has been going on for the last 6 or 8 months, as you'll see from one of the slides shortly. So this is all about how we're going to deliver the projects. And this is really important. Obviously, you can't build a project without the funding, but equally, you can't build a project without a plan and an execution strategy to actually deliver it. And I think that is really important that everybody understands we're setting ourselves up here to deliver this project, and there's been a lot of work been going on. It's not the sort of stuff that we can report on particularly, As we go forwards, that will more likely be the case. But I just wanted to go through how we're actually going to deliver this project. So basically, this slide just shows we've divided the project up into 7 work packages. This shows the first 4, which is the number 1, highways connection. Number 2 is the process plant. 3 is the portal and declines to access the mine. And number 4 is the remainder of the surface infrastructure. And on this next slide, we see the remaining 3 packages. 5 is the tailing storage facility. And 6 and 7 are the 2 things that we have to bring to site, which is the power via a connection, 15-kilometer connection to the main power grid. And number 7 is the water, which is going to be a 20-kilometer supply from the upstream of a dam fairly close to the project. So those are the 7 packages we've focused on in working out how we're actually going to deliver this project. This next slide shows what we've come to. So we're looking at ultimately an EPCM contractor to help us deliver this project. But the first step with the 7 packages is that we will actually put out the basic design ourselves to the appropriate engineering companies. We're separating out the process plant to actually go to a specialist engineering company, and that will be awarded first. And the remaining 6 will actually probably go to the same contractor, who may well then become our EPCM partner as we go forward. So we've had a lot of engagement with a number of companies. And on the next slide, we can sort of see the level of work that's gone into this already. So in terms of the process facility package, we actually went out for expressions of interest, pre-qualification, going back to April of this year. We got proposals back. We've actually negotiated the price. And by mid-June, we actually had that package ready to go. But we weren't in a position with the cash available to actually commit to that piece of work, because that is quite a large, costly piece of work. So that's been held back. But we're now in the final stages of getting the contract in place. And the expectation is that we will actually have that package awarded and placed by the end of this month. And that will be something, obviously, we'll update on when we get to that point. In terms of the other 6 packages, which is also a substantial amount of work, we went through some discussions, actually largely in country, with potential engineering companies that could deliver this. We went out for expressions of interest, pre-qualification at the beginning of October. And right now we're actually in a position where we are awaiting proposals back from 4 companies. We actually had 7 that we went out to initially. We actually picked 4 of those, all of those with international experience and internationally recognizable expertise. So a very detailed process, a lot of work gone into that, a lot of feedback, interactions, clarifications provided. But we should be in a position, if we get those proposals back by the end of this month, which is the intent, that by the end of the year, we should be somewhere near ready to actually award those packages. And then we can actually push forward with the work that we need to do to prepare us for construction. And I actually see this as sort of, early construction, pre-construction work, because the cost of all of this engineering was actually included in the feasibility study CapEx estimates. So the money that we've just got with the deal we did last year is a massive trigger, as Charles has said, for us to get the rest of the funding in place. But it is also a trigger for us to be able to get on with this work, which puts us in a really good position to commence construction. This next slide just shows work that's been ongoing. I think we've reported this in updates. We've got drilling work going on site. So a series of deeper holes along the decline, and also a couple of additional holes into the ore bodies. So we've done a couple of the holes on the decline already, and the remainder of that is ongoing, and that'll be completed in the first part of next year. We've done a large number of surface shallow geological investigations, and also some geophysical work. And that's to inform the design that we're now about ready to start for all of the surface infrastructure, the process facility, and creating the portal for the declines. So all of that work is almost complete, the shallow work, and that will provide the data to the engineering companies to do the design. And there on the right, just showing the core store out in Chemisset. And I have to say, I've been in there a couple of times, and the standards, the way that the core has been looked after, logged and protected is second to none, and really good. So there's a lot of good work been going on over the last few months to get all of this data ready for the engineering design. 1
minute to go, Graham.
That's all I need, Donald. this is just to shows the sort of the milestones that we've ticked off, culminating in the strategic equity in the fourth quarter of this year. And obviously loads more work to do, but that really does allow us now to crack on with the work that we have to complete. And I'll just leave this slide up. It is really important that we use the words "always do the right thing" and do them in the right way, and that is fundamental to the way that we're delivering this project, our interactions in country, and the way that we're actually going to go forward. So that's it from the presentation, Donald. So we're happy now to take some questions if you have any.
Fantastic. Well, I certainly have some. And Sean McInespy has one. He asks, when is the ESIA due? Now, is that the environmental impact study?
Yes, that is. And we were hopeful that we would have had that earlier in the year. That's been a very detailed process. We did put an update out fairly recently about that. We've had to go back and provide additional data to the authorities. We believe now that we've fulfilled all the requirements. And we are still waiting for a final meeting and the formal approval to come through. So we do expect that in the not too distant future.
I would say, is that just not simply in the nature of permitting and so on? It may look simple and straightforward on the surface, but in reality, these things happen. Yeah.
I mean, it does take time. I'll hold my hands up to being over optimistic previously with that, but it does take time. It needs to be right. We've made sure we've delivered everything that we believe we have to do, and given them the input for them to make the decision. Undoubtedly, there are things that have sort of come in the way of that process. The pandemic, no doubt, and other things, the change of government in the country. But it is there, and that process will come through. I think it's important to note that with the investment, our strategic partner has done all of the due diligence. They've looked at this in detail. They don't see that as a concern. We don't see it as a concern. It's just a matter of time.
Excellent. A general question from the LAC chat board: what counts as pre-construction and what counts as construction?
This may be subjective. I'll give you my view. I believe the work that we're doing, once we've got the basic engineering underway, that is sort of pre-construction work. As I said, the cost of that was included in the capex estimate in the feasibility study. So I think that is getting us ready for construction. Actual construction is when we sort of physically break ground, which will be once we've got to financial close.
And when might that be? When might actual physical construction be? Is it Q1 now, do you think, more likely?
I think we're now really in the hands of the banks. They will sort of dictate the speed with which we can get the debt funding in place, and it is now down to them. They were needing for us to give them an indication that we had the equity side of the final financing, not necessarily completely in place, but that we gave a good indication that we had a strategic cornerstone investor in place. We've delivered that now, so the conversations with the banks will speed up, undoubtedly, and really the length of that process is down to their due diligence and getting that all pulled together and everything signed off. So we will update on that when we have a clearer picture on on what the time is going to be.
Stephen Peake asks an interesting question. He says, he titles it "Inflation. You've begun the tender processes. How is pricing likely to compare with the original budget study?" With your feasibility study, he means, I think.
Well, we have done some work along the way. There's been nothing identified that where we see any dramatic increases in costs. Steel prices are maybe higher, other things are maybe cheaper. So I think this engineering phase will give us a much clearer picture of that and any significant issues. But there's nothing we've identified that gives us any concern at this point in time.
Okay, perhaps one for Charles here. To what extent does the fundraise further de-risk the project and make it easier to raise funds? And what are the next financing steps? How much can you tell us?
Yeah, well, as I was saying just before, it makes it miles easier for us to have this supportive 29.9% shareholder. GSM it's a pool of very high net worth guys from Asia who are basically investing in development projects outside of Asia. They've invested in some assets in Australia and in the US, and now this one, in order to take them straight through into construction. Having someone like that with pockets, deep pockets, and being supportive makes all of the equity issuance much easier. And what I would also note is they are going to be long-term shareholders, but they were not the off-takers we were expecting to have to give away to get a strategic. So we still have the off-take in hand, and we certainly consider that to be quite a trump card. And it might mean that the final tranche of equity is actually done with another strategic who actually wants the offtake. So the banks we've never really seriously had a problem with. The project has very high margins, so they all want to lend. But with a market cap our size, they were all concerned that we wouldn't find the equity. I think we're showing a pathway to that now, and people are going to realise, wow, this thing could actually start trading up to a sort of a more normal NAV discount. Okay. They don't need to issue stock in the market because of this 6.75 up front.
You brought us to offtake. So where are you with the offtake agreement? Where are you with salt? And what's your relationship with OCP? Are they a potential strategic still in the background for you?
There's 4 or 5 questions there, Donald. I'll try.
Only 3, Graham. Only 3.
Only 3. Okay. So with the potash offtake, as Charles has said, we still have that. We have ongoing conversations with potential customers who have an interest in the offtake, which may or may not involve some element of funding. So those conversations are ongoing. We will move forward with that now as we've got a clear sort of run into the debt funding being in place. So we know we need to have some offtakes in place. Potash, I don't see any issues, with delivering that. The salt, we're now working on that. We're engaged with some potential customers, but the target with the salt is we're actually, targeting 2 million tons minimum offtake for the salt, for de-icing salt, rather than the 1 million assumption that's in the feasibility study. And again, confident that we can get that in place. With regards to OCP, our focus, and this is something that I am really pushing with the whole team and the board, our focus is on delivering this project. If OCP want to come and talk to us, they can come and talk to us. But our focus is on delivering this project. Ultimately, they're an obvious customer for the product because they import MOP into the country. But we feel the best way for us to get the best value is for us to push on and put ourselves in a position to deliver this. And with the strategic partner on board who are very supportive and want to build this project, we now have the pathway to do exactly that.
Okay, excellent answer to my 3 questions. Let me turn to politics. I was either going to do it at the start or at the end, and we're coming to the end. So Morocco has a new post-Islamist government and a new Minister of Energy Transition and Sustainable Development. What do you make of them, Graham or Charles, equally? And are you keen to meet with Leila Ben Ali, who's the new Minister of Energy Transition? What are your thoughts?
Yeah, absolutely. I think I was in Morocco just sort of after the elections, and when it was clear, who the new government was going to be, and everybody I spoke to in the country were, really excited about the prospect of what this government would bring and their approach to the economy. And actually, they'd had a period of a government talking about doing a lot of stuff, but not actually doing much stuff. So they were, really enthused by the appointments that were being made by the Prime Minister and the appointments. So, I think we feel the same. Everything they're talking about doing fits exactly with what we want to do in the country, which is, deliver this project for the benefits that it brings. There's very strong ties between the UK and Morocco, and growing stronger, maybe post Brexit, but we're seen as a very, very strong partner for Morocco. So absolutely looking forward to meeting the ministers. Travel's become a little bit more complex again to get in and out of Morocco, but the plan is that we'll be out there certainly in the new year, if not before, and lining up some meetings so that we can actually talk about our project and make sure everybody understands what we're doing and the benefits it brings.
Excellent. My final question from Lloyd Phillips, a 2-part question again, I'm afraid. He says he would like to see more RNSs or communication around things like the construction start date. And he would, on a more supplementary point, He'd like a more steady flow of tweets and pictures to illustrate the smaller but nonetheless interesting moments. You know, for example, when new machinery is purchased, new staff are welcomed and meetings take place. So more RNSs at the top level, more comms at a lower level.
That's my bad, Lloyd. Thanks.
What are your thoughts on that, guys?
So listen,
around the project.
We put out usually 3 tweets a week, which I consider quite a lot for a corporate. We're quite active on LinkedIn, and RNS is obviously only for price sensitive information, so you have to just release that as it's appropriate rather than use it as a marketing instrument. But I think, in fairness to Lloyd, we probably have been in a slightly frustratingly quiet period because we've been negotiating this sort of deal, which you just can't talk about during the negotiations. And though we've been doing stuff on the ground, it's not been anything like the quantum that you're now going to see as Graham activates all this sort of pre-construction activity. So hopefully, even though you might not see many more than 3 tweets a week, hopefully there'll be more news to talk about. And if it's not RNS, we'll make use of other media outlets to get it out so that people can fully engage again with the progress, which will be more demonstrable.
Charles?
Yeah, second that. You know, we at times we're sort of limited to what we can put out. There's a lot more going on now, and I encourage all of the guys to take photographs of not everything, you know, anything that might be interesting. You know, so it is the intent to make sure that we're updating as we go. And as Charles just said, there's a lot more activity, a lot more interesting stuff. It certainly interests me and excites me, and you know, we'll share that as much as we can. Okay,
Graham Clarke, CEO at Emmerson, and Charles Vaughan, Commercial Director. Thank you so much for joining us tonight. As I say, I'm a big fan of your project, and I've been following it for a long time. It's terrific to see you doing well. Thank you so much for joining us. Our final company this evening is Technology Minerals, who announced today that they will IPO on the London Stock Exchange's main market tomorrow morning with the ticker TM1. TechMin are focused on battery metals, both as an explorer for cobalt, nickel, manganese, and lithium, with 6 exploration projects underway in America, Spain, Ireland, and Cameroon. Can you believe it? And also at the other end of the cycle, as a recycler of lead and lithium-ion batteries. Technology Minerals have their own IP for battery recycling and are currently building 2 factories, one for lead batteries, the other for recovering battery metals from lithium-ion. Alex Stanbury, CEO, joins us live to make the investment case. Welcome, Alex.
Pleasure to be here. Thank you very much for having me. And as you say, this is an extremely exciting time for us, the eve of our admission to the London Stock Exchange. This has really been the culmination of a huge amount of work, and it's really a new chapter and a new era for Technology Minerals, and it's going to allow us to kind of move forward at pace and develop our strategy. So yeah, really exciting times. I'll take you through our presentation now. So we've got our disclaimer, read that at your own leisure. As I said, Technology Minerals was set up to take advantage really of the time we're in a society where we really need to be looking at less extraction and more reuse. So creating a circular economy. And we are the only UK listed company to create a circular economy in the battery metals space. We are very happy to be involved in the decarbonisation of road transport, and we will be exploring and mining and recycling battery metals from spent batteries. So a lot of exciting stuff going on. I'll take you now onto our group structure. You can see that we have 2 sides to the business, which is how we create our circular economy. Firstly, we have our upstream projects. So we've got 6 resource projects, 3 of which sit in the US, 1 in northern Spain, 1 in Ireland, 1 in Cameroon. And then our recycling side, which comprises of lithium-ion battery recycling and lead-acid battery recycling. I'll take you through all of that in detail later in the presentation. But firstly, we'll go through our resource projects. Here's a map of our resource projects. You can see that we have a fairly wide spread of projects across the globe. This is in order to shorten supply chains in our view. There's a burgeoning battery manufacturing sectors in each of these areas of the globe, and supply chains should be as short as possible. The US, for instance, has no nickel mining, no cobalt mining at the moment at all, and no processing, and obviously a number of gigafactories going up there as well. So it's important that they have their own supply chain of critical materials, and that has made its way into US policy recently as well. And then we've got a lithium project in Ireland, a nickel copper cobalt project in northern Spain, and a nickel laterite project containing copper and cobalt as well in Cameroon. So I'll take you through our projects one by one. Firstly, our Blackbird project, which is currently under option, an option we intend to exercise fairly shortly after IPO. You can see, if you look on the map on the right-hand side, this is a map of Idaho near Salmon, and you can see our Blackbird project there and the Imperium project next to it. The Imperium project is about 14,000 acres, so it's very large and takes up the entire sort of loin really of the Idaho cobalt belt, and the Blackbird next to it is contiguous and sits just below the red circle there, which is our neighbor Jervois Mining. Jervois will be the first producer of cobalt in the US and are on track to be producing in 2022. So that, in our view, will bring a whole new focus to the Idaho Cobalt Belt, which is, by the way, the only place one of the only places in the world and the only place in the US that grades high enough in cobalt that you can mine it as a primary product, and rather than it being a byproduct of nickel or copper mining. So strategically, the Idaho Cobalt Belt is hugely interesting to the US and to the US government. So we see a lot more focus coming to this area in the next year or two. And you can see in the photo at the top as well, the topography. It's extremely friendly around there. It's got extremely good access and power and water. It's national forestry land, so it's extremely easy to get in and out, and all the roads are very well serviced. That there is where Jervois are setting up their plant, and as of last week, they actually blasted their first blasting in order to start operating their mine later in the year. So they're fully committed, which bodes very well for us because the permitting side of things has all been done. And as I said, if you can also see that we have them boxed in on the along strike. So once they're producing, I'm sure that they'll have an interest in talking to us. The Blackbird project itself has historic drilling on it, all of which has produced very decent results for cobalt and for nickel. It was drilled by Noranda. We have 23 drill holes permitted there and we're planning to drill 16 of them next year. So there's some good progress to be had there in fairly short order. The Imperium project is 694 claims. As I said, it covers 14,000 acres, so it's very, very large for US terms anyway. And it's all near the town of Salmon. And this is a very large historic mining district. The Blackbird mine, which ran for 22 years, is just below our project there as well. And then moving on, we have a polymetallic play in South Dakota, which is quite a novel play. It would be low capex and easy to mine. So we're rather excited about this prospect. We've had 2 field visits this year and are just waiting for the assays back. But it's a manganese-focused play with outcropping mineralization at surface. So again, as I said, it should be extremely exciting to get the news flow out of that. Moving on to the next slide, which details our Irish projects, our Spanish projects, and our Cameroon project. We'll start with the project in Ireland. This is a spodumene project, so hard rock lithium. We've had some very high grade 1.75% float from that project, and it's currently being drilled by our partner, joint venture partner, Global Battery Metals, who are listed on the TSXV. We're waiting for the results of that drilling program, but at the moment it's a zero cost to us, and they're earning into our entirely owned project. Then we have our project in northern Spain, which is 7 exploration permits. You can see that on the map in the middle. There are the St. Patrick license is the first one of ours to be granted, which is the, if you're looking at the cluster of licenses on the left-hand side, it's the one on the bottom. That actually works very well for us. It's a big license in itself and has an awful lot of work to be done on it. It's the site of the old Aramo mine, out of which 200,000 tons of ore were recovered, with very high grades of copper, so up from 1 to 20%, nickel from 1 to 3%, and 1 to 3% cobalt, so extremely high grade. We are now back down there doing work, and we'll be undertaking work actually in the old mine next year. And interestingly, the mine was entered at the ground level of a very large hill, and we found some very interesting mineralization on top, on the plateau as well, which has never been explored. So the entire hill itself has never had actually any exploration. So we've got all the down dip upside as well as the entire hill. So we're really chasing a resource there, chasing a historic resource and looking for a new one as well. So that's also drill ready on the plateau, and we were drilling in the old mine next year as well. So very exciting, and we're looking forward to moving that one forward at pace. And actually proving up a historic resource. Sorry, proving up a maiden resource, apologies. Then we have the Tmc project in Cameroon. This is located near Nakamuna, which was the old Geovic mine. Again, this was a project of a world-class project. We believe that we're on strike to that. We've had some results that would make us believe that as well. So these licenses themselves are all huge. Each license there is 500 square kilometers. So our next port of call is to do fly an aero mag and then do some reconnaissance drilling. But this is potentially a very large nickel laterite, which will feed into the battery manufacturing sector, which has got very large forecast shortages of nickel. So onto this slide, which basically just shows you where each of our projects lies on the value curve. At the top of our value curve, really, we have Astamet and Leinster. This is one because we have a historic resource there, and secondly because we're drilling. The Blackbird project has a little bit of historic drilling from Noranda, and then we're lined up to drill 16 holes next year, which will take it further up the curve. And for those 3 projects, we hope to be approaching a maiden resource in the very near future, which will obviously be a great step forward for Teck Minerals. And then we have Imperium, Oakama, and Cameroon, each of which are at various stages of their exploration programs, and we have exciting programs laid out for each of those for the coming year to move them further up that curve. And just going on to our milestones for the next 6 to 12 months, as I said, for Blackbird, we have 16 drill holes planned. So as soon as the snow melts in Idaho around March, we're in the contact with drilling contractors at the moment and hope to be able to start drilling there early next year. Imperium will be doing regional and detailed mapping, soil and rock chip sampling over the rest of the ground that we haven't covered yet. And we've already got 4 very exciting prospects out of the ground, which we'll be doing deeper exploration work on, including channel sampling and trenching, and we'll do some further geophysics on the entirety of the license area as well. Leinster is being drilled by Global Battery Metals, as I said. There's no expenditure due from us at the moment. In due course, we do have the right to spend money and retain our ownership. So we'll see how that goes. But we plan to do so, obviously. And then Astamet, again, as I said, we've got the underground mapping sampling. We've got a health and safety assessment coming up to make sure that we can enter the mine safely and do the requisite metallurgy tests and the underground drilling as well. And then we'll be doing mapping, sampling, and spectral analysis and drilling on the plateau. And TMC, we've got field mapping and sampling, and really the key there is going to be the airborne mag, which will lead us to doing some reconnaissance drilling. And in Wakama, we are going to continue with our field sampling and just seeing where the results lead us, and taking an XRF out with us as well to hone down further on where we want to focus for our pacing, trenching, and then drilling. And then that takes us to the other side of our business. Obviously, we are focused on a circular economy, and as much as we want to provide the metals for the battery metals industry to create lithium-ion batteries, it's also critical to us that we reuse the materials that we do extract and that everyone extracts, and that it's not all just about extraction. It's incredibly important to be looking at reuse. And it's very much on everyone's agenda and the forefront of everyone's minds at the moment. So we started Recyclus, founded Recyclus a couple of years ago, and now really at the forefront of our field there. We're extremely happy with the progress we're making. We aim to lead the lithium-ion battery recycling market and move the automotive industry towards 100% recyclable, zero landfill solutions. We're doing that within our recycling solutions ourselves as well. Here's a quick table just explaining the size of the market. You can see on the lithium-ion side at the moment, the automotive is only 10% of the market, whereas lead acid is 90%. You can imagine with the banning of ICEs and internal combustion engine cars in 2030, how much this is going to shift and how quickly it's going to shift. And there's going to be a huge amount of lithium-ion batteries floating around and needing recycling. So we aim to solve that problem on an industrial scale for the UK and then into Europe. So just take you on to our business model for Recyclus. On the left-hand side, we have the providers, the batteries to us, and on the right-hand side, we've got the paying customers. So we have a joint venture with a large automotive waste oil recycling company in the UK, who have 13 depots around the UK and a fleet of transporters. So we've teamed up with them in order to get supply of feedstock from both the lead acid and the lithium-ion side. Lithium-ion batteries are extremely dangerous, and transporting them is a hazardous pastime. We're also actually within Recyclus manufacturing our own battery boxes for the safe transport of lithium-ion batteries, and then we have various other battery providers as well, the digital marketplace, as well as industry partners. There'll be insurance companies as well. So 400,000 cars a year go to the insurance industry, and they're used to dealing with them, but they're not used to dealing with lithium ion. So we've had many a conversation with the industry, and they're extremely happy to be having someone solve their problem, because they don't want to be left with lithium ion batteries sitting on site. There's also the battery suppliers and manufacturers, and also the gigafactories, which are being built in the UK as well. We're in the midst of conversations with all of them to supply front-end feedstock. So we have a good spread of feedstock suppliers. And then on the other side of that equation is obviously what we do with the materials after we recycled them. So we have the plastics and the metals, which get sold out into the trade. And then we have the black mass, which goes to the refiners. It is our aim in the next couple of years to have a hydrometallurgical process, which we will put onto the back end, that will then take that black mass back to its constituent parts, and we'll be able to create a circular economy within that industry itself as well, and sell the black mass, sell the constituent parts, so the salts and the metals, back to the battery manufacturers, so that they can then use them in the manufacture of their new batteries as well. This is just a quick table on our revenue mechanisms. You can see that on the left-hand side, it's recovered materials that we can either trade out, we can get grants from the UK government, and we can also license our technology, which we hold the IP for. So we own the IP and the process, and the IP on the process for the recycling technology for both lithium-ion and lead acid. And on the lithium-ion side, we also get gate fees, as we're solving a problem for the OEMs and the battery manufacturers. we actually get paid a gate fee to take in that feedstock. On the lead acid side, we pay for the batteries, but there's a lot of margin there, and we are also the only solution that's actually creating zero to landfill. The traditional way of dealing with lead acid batteries has not been terribly clean. It's either been landfill, manual soaring, or being put directly into smelters, which obviously involves burning plastics and battery acid. So we are an industrialization of and cleaning up of that process, and we plan to expand throughout the UK. It's an old business, but there's a lot of volume. A quick slide on our competitors. You can see that we have, we aim to be a full service, and we are a full service company. We are ahead of our competitors in that respect, and we can take all types of batteries and all architectures and all chemistries. So, we are also a UK company. We're building our plant in the UK. We're using UK engineers, and as I said, we own our own IP and IP around our processes. So it's very exciting, and we believe that we are cutting edge and at the forefront of our field. The milestones on for the recycling side for the next year, really, the key here is to get these plants up and running. We have 2 sites, one for each technology, both in the Midlands. The plants are, one of which is going in as we speak and will be commissioned end of December, beginning of January. And the second one will be and the lithium ion is going in towards the beginning of next year, with a view to being active at the beginning of next year and then commercially up to speed by the end of Q1. We are already revenue producing by trading lithium ion, but these will obviously kickstart the company into very serious revenue generation and allow us to then build out further plants as well. So whilst those are being built and commissioned, we'll be adding further commercial contracts and partnerships. And once they're up and running, we'll be ordering new plants to put in further sites in the UK. So we plan to roll out 6 lead acid plants in the UK, and we'll have 2 to 3 lithium ions over the next 6 years.
1 minute to go, Alex.
Okay, thank you. Well, actually, just good timing. We're just finishing up here. In conclusion, we are the UK's first listed company focused on creating a sustainable circular economy for battery metals. And we believe we're perfectly positioned to take advantage of this 21st century transport revolution. We are a British company, and we're poised to be a key player in the supply and security of battery metals through the ownership of vital mineral assets and control over the recycling technology for which we have the IP. And we also aim to develop our own existing mineral assets, acquire new projects as a public company, and further expand into the battery recycling business by creating new partnerships and also rolling out our business across the UK. And we have a very experienced management team, which I head up and I'm very proud of. And we're ready for the challenges that lie ahead. And thank you very much for listening to me this evening. Wonder if you've got any questions at all.
Okay, Alex, so first of all, congratulations. You IPO tomorrow. How exciting is that?
Incredibly exciting, yes. It's been a while in the making. A lot of hard work's gone into it, and I'm very proud of the team for getting us here.
Yes, as Dylan said, it's a slow train coming.
Indeed it is, yes.
Very good. Anyway, congratulations for tomorrow when it comes. And remind me, you raised, what was it, 5.5 million for pre-IPO and $1.5 million around the IPO? Is that correct?
Yes, it was almost 5 in the pre-IPO and 1.5 coming into the IPO gross. So yes.
And very, very roughly, just quickly give us a sense of where that all gets spent.
Absolutely.
Asset allocation, as they call it.
Of course. Quite a lot will go into getting the lithium ion lead acid battery plants up and running. That's the key to us now. Obviously, both sides of the business are extremely important, but that is cash generative. And as a junior mining company, to have a cash generative asset is really, really exciting for us. having been in the corporate finance world before I got involved fully on the operational side of mining, whatever it was, 2008. It's very nice to actually be in a position where we can have, well, I'm in charge of a company where we're going to have cash flow rather than the usual junior mining model. So,
indeed, tangible assets. Okay, talking of which, Dinesh Nair asks a very pertinent question. Only 49% of Recyclers is owned by Technology Minerals. Who owns the remainder?
The management team.
Okay, very good. So who owns the 49% then?
The management of Recyclers, which includes myself, Robin, and 3 non-executive directors.
So it's Recyclers, and you're part of that team on the one hand, and Technology Minerals on the other hand, and you're
Absolutely.
part of that team as well.
Yeah, absolutely. We stand independently at Recyclers as well for various reasons, and it is an independent business. But Technology Minerals founded it to be part of the circular economy for the group. And also to have a cash generative asset within what we're doing, but also, you know, it's extremely important from a circular economy perspective to have that. But you know, the business will be looked at differently and rated differently and attract different pools of capital as well. So, you know, as we go forward raising money with Technology Minerals, we'll continue to invest in Recyclers to keep our ownership at 49%. Okay,
Josh Cole asks, these are always very tricky questions, I'm afraid. Sorry, Alex. Where's your share price going to be 12 months post IPO? So in 12 months' time, when we come back to interview you, what's your share price going to be?
I'd love that crystal ball, but we have a huge amount going on, and I'm excited by all of it, as is the team and the board here. So I believe we can do a very good job of through communicating with shareholders and communicating with the public and getting our news flow out there and moving our share price solidly north.
Riz K asks, how many times can the batteries be recycled? So how many times can a lead acid battery be recycled, and also a lithium ion battery be recycled?
That's a very interesting question. If you're looking at a truly circular economy, then you know, in that particular market, then I think for the lead, it's actually exponential. You know, I don't think there's any limit to it at all. And the quality of the lead that comes out once you've refined it is as good as the lead that went in on day one. And then it's really down to the other plastics and the metals, all of which are infinitely recyclable as well. And then so I don't think there's any limit. There are certain components that have very tight tolerances on the lithium ion side, so they may be recycled into something else rather than batteries. So yeah, you can continue to use the components, but not necessarily as batteries.
Dinesh Nair asks another question, a very good one, I have to say, a pertinent question. Tesla already offers a battery take-back service. Won't other car manufacturers follow suit and develop a recycling capability in-house? Why wouldn't they do that?
Yeah, it's an interesting question, and we've spoken to a number of OEMs who are keen to potentially bring us in as being their solution. They're not in the recycling game. This is not what they do, and if they're doing it, they're generally doing it out of a lack of choice and a needs must. So we aim to. It's one of the reasons we are pushing ahead so rapidly now, is to make sure that we're in a position to offer them the service that they require, so that they're not stuck in a position where they have to go out and develop it themselves.
Okay, what's your strategy? Do you foresee into the future that revenues and profits from recycling will continue to fund the exploration side of the business? Because they are two quite distinct parts, aren't they?
They are. You know, a lot of the profit from the recycling will be used to build out further recycling plants. And you know, we have a strategy for that over the next 6 years in the UK, and then probably into Europe. So and definitely, you know, there will be some of that money will be funneled back into Technology Minerals. As I said, you know, having been in the corporate finance world and seen junior miners who get caught on the wrong side of a commodities super cycle and find it very difficult to raise money. You know, I want to be in a position that the least we can do is continue to move our projects forward, should the market sort of sentiment move against mining companies, which it does from time to time. And then when the super cycle comes around again, you're in a position to, to really strike hard because you've been able to put money into those projects and advance them in a time when other people are sitting on their hands. Okay, talking of super cycles, where exactly are we in the exploration cycle at the moment, do you think? Because you're putting your money where your mouth is in 6 different projects at the moment. Absolutely. I think we're at a fantastic time for this. Timing's everything. We have a massive EV boom, and we have a forecast shortfall in nickel, cobalt, lithium, and a real that undersupply can't easily be met. There's been a massive underinvestment in junior mining over the last decade, and this is now being noticed. But you can't just plug that gap. We are there to try and plug a part of that gap. But these shortfalls are real, and they will happen, and they will affect the OEM's rollout of some of their vehicles, and certainly the prices in the market are likely to rise as well. So I think timing-wise, we're pretty spot on. Alex, the audience has stayed with you loyally through to 8:05 tonight. Reward them with one last answer, please. Why should they hold your stock? Why should they buy your stock tomorrow morning, Alex? Well, for many of the reasons I've just been through, I think we're an extremely exciting proposition. We are a circular economy in battery metals. We are unique in that respect in the UK. Battery metals recycling is absolutely vital to the environment and what we're doing, and also a market that's growing with incredible speed. So on both sides, the extraction side and on the recycling side, I think we are an extremely exciting proposition for people. Okay. Alex Stanbury, thank you so much for joining us. Alex is the CEO of Technology Minerals. TM1, look out for the ticker TM1 tomorrow when it lists on the main market of the London Stock Exchange. Thank you very much indeed for joining us tonight. Thank you, Donald. And that's it from us after a wonderful evening. My goodness, that flew by. Thank you very much to all our speakers for joining us live from around the world tonight, and to all their teams behind the scenes for getting behind them to get them here. We really do appreciate that, and we understand it's very hard work. And a huge thank you to you guys for being such a great audience. I'm so grateful to you for staying with us to the end. Hopefully it wasn't a bitter end, and we're truly grateful for your time. Good night, and may all your investments go up.